In our most recent video, we discussed the idea that debt maturity was going to become a big problem, and the Japanese yen continues to be a huge issue as it's spiking out of control, especially over the last 4 weeks. The markets don't seem to be responding to it just yet. Even with the US 30-year yield going past 5%, it hasn't been enough to take the market below its put wall. But could this change over the next coming sessions? And what happens if we go to massive negative gamma? In today's video, we talk about how close we are to these events and why everything matters in the potential of distribution. Also, money keeps flowing into those hedges. Guys, we've got a lot to discuss. Let's cover stocks, commodities, and cryptos right now together. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the data, and of course, the options flow, which became one of the most important factors of the last 24 hours. Let's kick things off though with where we're at so far. And you may be saying, is that a really blurry chart? Yes, it is. But what it does show us is it shows us that after the US trade, China kind of reduction in tariffs, that forced the markets to levels that we've never seen in terms of recovery off the first drop, and not to make an all-time high, and also to actually not go into a recession straight away. And this brings up a really interesting point. I thought we'd kind of go through it today together in terms of when we see these types of reads, what happens over the smaller timeframes, and then what happens over the next 256 days. So, of course, resoundingly, everything tends to be positive across the board. 21 days later, though, or even 63 days later, that's where we've often had the problems. And I think the key point here that we want to look at is the fact that we've already seen huge amounts of breadth thrusts, Zweig breadth thrust, 770 de Graaf, and even a Whaley breadth thrust. And all of these are really starting to say, of course, the markets are most likely going to do this. But at the same time, because the markets rallied so much, sometimes we will get pullbacks. And as you'll find out in today's video, there are some reasons why that could continue to happen, especially if we break this options level. Let's talk about overall US health for now. We do know that tariffs tend to front load demand, and that's kind of showing up here in US rail traffic. It's up over 2024, and we're still seeing quite strong growth for now. Now, could we be going into what's called the bullwhip effect? We'll talk about that in a subsequent video, so make sure to subscribe for it. But a bullwhip effect would be a pretty wild event indeed. Let's now talk about where we're at in terms of the first 100 plus days of Trump's presidency. Obviously, we're following the path that only a few have. And in all cases, generally, we were usually seeing some pretty strong recoveries. And then something was happening around that 225 days into the presidency. That seems to be kind of that marked event where we either go more of the decline and structure goes through, or we end up in the, okay, everything's all good, don't worry about it kind of phase. This will be an interesting chart, certainly one to be watching. So you're probably aware by now, if you've been watching the channel, or even if you've been looking at any of the news, that people are starting to get a little bit concerned about the bonds market, in particular yields. Now, we saw a 20-year treasury auction not do very well. It was actually one of the worst in years, and that caused everything to spike. But we've also had Japan and other central banks around the world seeing big spikes in yields. And this is causing some concern out there. And of course, the reason why is liquidity in Japanese bond market levels is currently at Lehman Brothers levels. Yeah, we haven't seen these kind of levels since, well, yes, we saw once over here, which ended up getting, fixed. And then, of course, the last time we saw it was 2008-9. During the heights of the global financial crisis. So what gives? Well, the issue with these overall really high yields, especially in Japan, is that but Japan's the number one creditor, so what's going to happen is people may bring back money into the country, and that can create a full liquidity, kind of stability issue across the world. It also brings up the question of whether we have a debt wall coming, which we've talked about a few times, and the debt wall is really this: 38% of all US treasuries needs to be financed over what's been going so far, which is, of course, the front load, 2024 into 2025, third quarter particularly of 2025 into 2026. So a lot of money needs to be shuffled. And it's not a question, I think, of whether treasuries can do it. It's really more probably a question of whether we will see the smaller companies be able to do it. So let's take a look at this chart before we go back over there to debt and talk about debt maturing for small caps in particular. The Russell 2000 faces a big challenge. Remember back in 2021 when no company had to earn any money? Well, of course, that's changed now. And what's occurred is we've seen basically businesses across the board that refinance themselves at really low cash rates have to do it again now. Now, if you know your Russell 2000, you'll know that 36% of businesses inside the Russell don't make any money. So how are they going to refinance come the end of this year? Are we going to see zombie business apocalypse? And usually I always say if somebody knows something's coming, then it's not necessarily going to become the issue. But, it still could be used as a narrative. And even then, there are other problems in the debt markets that need to be addressed. So just remember, huge amounts of debt being refinanced coming into the back of this year. Speaking of debt, we also have a couple of other problems going on right now. And one of those is Americans are falling behind on their car payments, and it continues to rise throughout 2025. And I'd say each number is going to get worse and worse and worse. And what does this mean? Well, we're at an all-time high here in terms of delinquencies. We don't necessarily obviously crash in a market just because we hit these highs. I mean, over here, of course, the market's continuously rallied up, but it was kind of a precursor generally to some problems starting to arise. Maybe it's people are over-levered, people are losing their jobs and they just don't have it, and we're not seeing that yet in the economy. Who knows, really? But the main thing here is that most people have too much money and debt on their cars. And the reason is in 2021 and 2022, as we all know, people were paying over sticker value. So a lot of these cars are actually under their own debts. So effectively, people owe more money than the car is even worth. So how's that going to play out? The other one that I've seen come up recently is a buy now, pay later for your food, your fast food. You want to pay $30 at McDonald's? Well, guess what? You can do that now in 4 easy payments. Is that a sign of things to happen or things to come? Maybe it is. People are literally debting every single thing you can think of nowadays. Have you ever done that? Let us know in the comments down below, or if you know people that do buy their fast food in 4 easy payments. Let's now quickly talk about market sector changes. Obviously, we already knew that markets were turning defensive over the previous kind of 4 sessions. The last 24 hours, not that much change. And we'll just quickly go over here again. You can see here that technology held up and some of the defensives started to get a little bit of rotation out of them, which could suggest that we're at that little bit of a support zone. But let's have a look here at the overall big dark pools and big trades. So we can see one large trade came in on the Qs over the last 24 hours. It's been quite a lot here. In the past, we've seen a lot of trades go through this exact level. Could this be a sell? It's possible, but we don't have, of course, that market making a new low, which we'll look at later on, because it could be that actually the Nasdaq is in a Wyckoff distribution. And one thing's for sure is we know there is a very key level, and that's the highs of 522. If we go back up and we break that in the future, that's going to be a really strong sign for market bulls, because we know that's a massive cluster. Huge amounts of transactions, lots of algorithmic style transactions coming through at that level. And at the same kind of time, we also saw VOO, the big S&P 500 fund, transacting in clusters as well. Not the same level of cluster that we did on the Qs, but certainly something happening. So what gives? Well, we have the RSI 70, which is obviously an overbought level. We have the bullish percent index on both the S&P and the Nasdaq back into those kind of extreme take profit zones generally for a trader or a swing trader. And that can suggest that we're in for a little bit of a pullback. So far, we've got 3%. Will we get the 6, 7%? Yeah, seems plausible for sure. And we'll talk about that later on today's video if we break these key levels. And you can see here that in terms of smart money flow, smart money bought most of everything during that full dip. And then, of course, they've since then started to continue to purchase up, but they really were the winners of the dip itself. And of course, retail has been buying more recently as well. Retail just hit all-time records, 4.1 billion in US stocks purchased by midday on Monday during that dip. So remember, what did we see after that? Well, we've got the Tuesday kind of, rally, false rally into possibly sell off. We see all those clusters at these same levels. Could that be trapping in retail at least temporarily? And could it also be trapping in a bit of leverage? And leverage is absolutely through the roof at the moment. And that's fine. It can go higher for sure. This doesn't mean everything's going to sell off, but at the same time, it does show you conditioning. Look at that rally on the leverage like no other we've seen before. And that means that, no one's ever purchased more leverage quicker than what we've just seen. What about the overall narrative of markets? This is the one that tends to be overlining the best. I've got usually a 1960s or a 1990s narrative at the moment, both concentrated markets with, of course, very heavy stocks in them, which is what we've seen right now. And of course, speaking of concentration, the good thing about the rally so far, remember, it was formed through technology and through semiconductor stocks doing better. Let's have a look now at the S&P 500 charts. You guys can see here, central bank liquidity was slightly up over the last 24 hours, something to mark out. And of course, on the S&P 500, we stayed in a fairly tight range, just above the put wall, just around that 58.40, 58.50 zone, and also around this 4 hour, 20 moving average as well. Now, if we break below this, where do we go next? Of course, 56.60 seems like the most logical gap fill kind of zone, and there's a lot of stuff that's going on around that area. And we did see, of course, the first change of trend on the the medium time frames for the S&P 500. We go over to the futures market. You can actually make a case for two things here. You've gone from a series of higher highs and higher lows to a lower low that's being formed. Then you've kind of come down to this really contentious put wall area, and you've seen a market that's rallied quite straight off it in the futures market in the morning. And I remember in our private community, links in the description down below if you want to join that, by the way, that I was talking about this yesterday, and I said, I don't think this market is going to want to sell today because it was coming in kind of red, and it just didn't seem correct with the way it's kind of priced up. So you could definitely make a case for bulls here to try to pressure back into 5900, 5910, which is the most traded kind of zone. And you could basically, of course, make the case for the bears. All we need is a daily close a little bit lower, and that's going to push, really almost nothing on the left-hand side holding it up. So that's going to be the breaking point you would have to think for the markets. Now, why is that? It's options. Look at this. Interesting ones over the next 24 hours. Some weird ones coming through at 58.80, 50 kind of 900 zones, so actually above current price. And that means that if we open even here, we'd be a negative gamma for the session. So take of that what you will. Of course, if we do break below 5,800 is the first little stop for the next session. And if we take a look here at the 27th, you guys will notice 5,800 becomes quite a struck put level. So we went from calls everywhere to puts very, very quickly. Last 24 hours, the put wall hold up. At the moment, will the put wall hold again? Basically just means we may move up another 20, 30 points if it's going to hold. But if we see that cascade effect, of course, that may need some epic hedging pretty quickly. Tesla.
NVIDIA Corporation is preparing to report its first quarter earnings, with expectations of strong revenue driven by artificial intelligence demand. Analysts maintain bullish outlooks despite potential challenges from write-offs and geopolitical issues. Investor confidence remains high, with indications of strong demand for NVIDIA's chips, particularly in artificial intelligence applications. President Trump's threats of a 25% tariff on iPhones not manufactured in the US have led to a significant decline in Apple's stock price. Analysts suggest that this could force Apple to raise prices, benefiting competitors like Samsung. The stock has now fallen for 7 consecutive sessions, reflecting investor concerns over potential impacts on margins and production strategies. Tesla is navigating significant challenges with new legislation abolishing electric vehicle tax credits, which could impact sales. However, Wedbush's bullish outlook on Tesla's artificial intelligence and autonomous vehicle potential raises its price target to $500, suggesting substantial growth ahead.